All right. Matt, the mortgage guy, mortgage broker Q&A. I am live. I plan on doing this every Monday at 5 p.m. So anybody who's watching this on replay, if you have questions and you want to do the live interaction type of Q&A that I've been doing, feel free to join us Monday at 5 p.m. Pacific Standard Time. I'm going to keep it that time. I'm probably going to do a poll on my channel to find out if people prefer to do 4 p.m. Pacific, 5 p.m., 6 p.m. Really, Mondays are days where I'm in the office fairly late, and so I don't mind doing them later. But if people prefer 3 p.m. Pacific Standard Time or 4 p.m. Pacific Standard Time, I'm happy to do that. I'm really just doing this because in my experience, the last couple of ones I've done where we've done live Q&A, they've been super, super productive, and I feel like they've added value to anybody who follows the channel, because it's not just that you leave a comment and you ask a question that gets answered, but there can be some more back and forth. Sometimes people leave a comment, I'm like, I'm not sure what exactly you're referring to, but based on my assumptions, here's an answer to your question. And then maybe they don't see that for a week and they say, no, I was asking about this. And it stays open and it may or may not get answered. But when we do the live Q&A format, like I've done a few times here, we can really dig in. And I've had some great conversations. I've been able to help folks out that were looking at investment properties. We can price stuff, and I can give you some pretty accurate pricing based on, if you're trying to do an investment property, you're trying to do a primary, and really just open up the dialogue so you can get straightforward, direct answers from a loan broker. Whether or not you're in California, I can do business with you matters little to me, and people who follow the channel know that for years through YouTube and through other channels, I've been given advice all over the country, and it has nothing to do with me trying to generate business personally. It's really just kind of a passion project. And so despite what all the haters have said in the comments about, don't listen to this guy about his advice on the market, all that stuff, because he's just trying to pad his pockets, just trying to get business. Truly not the case. And if you understood the minute amount of income that comes from YouTube versus my mortgage business, if I was strictly a business person only doing it for the money, I would certainly not be putting as much time and effort as I have been into YouTube and whatnot. I truly enjoy it, and that's why I do it. So I'm looking forward to more people joining. Any questions that anybody has, I'm happy to answer them. Before I get any questions, and if I don't have questions coming in live, I might dig into a couple recent questions I've gotten on the channel and answer those. So first comment is from my buddy Bot4BS. What's up, buddy? That's my 12-year-old. You got to go check out his channel if you're interested in Brawl Stars. This guy's got some great Brawl Stars content. Let me tell you, he is making some cool stuff. And I don't know. I don't know what. I'll misspeak, but there's some OP content on there. I'm sure Ryan would agree with me there. Thank you, Catherine. I appreciate you following the channel, and I appreciate you always the kind comments and the good feedback. I think we connected you with somebody in your state. Hopefully they're able to help coach you through what is looking like an early 2022 purchase, if I remember correctly. And yeah, for sure they'll be able to help you out there. If you have any issues at all, please, if I ever refer you to somebody and they're not holding up their end of the bargain by providing great service, come back to me and let me know, because I'll either write it. And I have done that in the past too, where I've gotten involved and I've sent someone to a Nevada broker, talked to the Nevada broker said, listen, here's what I've done, and gets me up to speed on what's going on to make sure that if I'm trying to help serve you by connecting you with somebody else, that they're serving you at a very high level as well. Mail cold, no questions, just here for another informative session. I appreciate you being here. Without folks joining, I probably just quit this thing. I think the 7 or 8 weeks ago when I decided to do YouTube Live, I thought I'd do it as an experiment, and I'd go for 10 or 12 weeks and see what the feedback was. And so far, not only have I got great feedback, but I've also really, really enjoyed it. honestly. I think it was 2 weeks ago when I did the last Q&A solo, and I don't know, it was 2 hours and 20 minutes or something. Thoroughly enjoyable on my side. I really enjoy it. And you know what I recently thought of is I've got a bunch of people that I talk to on a daily basis that have questions. And the questions that they have, I'm sure other people have. I've started to steer people towards, hey, if you've got any more questions or any more questions come up before today and the next time we can get together on a call, because I've got people jumping on my calendar for calls and consultations, go ahead and jump on the live. Ask me the questions there, because then not only do I get to serve that client and help them out, there's other people listening that get served by that as well. So a bunch of positive feedback. I appreciate you guys. Thanks for all your videos. Thanks for watching. If people weren't watching my videos, then I'd stop making them. But it seems like as I do more and more business, I get to see more stuff. And when I see more stuff, I see trends in things that are commonly asked questions. And I see things like, appraisal gaps and what you need to do in this market. And if I can just turn on a camera and talk about what I'm experiencing in the market and it serves and helps other people, all the better, right? It's fun. I have an FHA that I closed last July. I paid down points and have a 2.75 interest rate. Should I refinance? I have 20% equity now with the current rates. Rob, I would say you could probably do in the 3% range if you've got good credit, depending on your credit. If you initially went FHA, it may be that your credit was, in the 600s. And so FHA was a better option for you. Or maybe you just, it was a debt to income ratio thing where they were more flexible so you can buy more house with FHA. But here's what I'll say. Here's my first initial thought on that is that you'll probably get a 3%-ish rate. You could buy it down to 2.75. And if you've got 720, 740 credit, my guess is, and this is depending on your market and loan size and all that other stuff, you probably could pay a point to get to 2.75 conventional. And with that 2.75 conventional, you can remove mortgage insurance. If the mortgage insurance is $200 a month or $300 a month, then you're doing really good, right? You're saving $2,500 to $3,500 a year in interest, or I'm sorry, in that mortgage insurance, right? That payment that's literally lighting money on fire. And so I probably would. One thing I'll say that I hope will help other people now is that when you're buying a house FHA, be very, very weary of paying points because you're likely not going to stay in that loan for that long. Once your credit has improved and you've got equity and you can refinance conventional to get yourself out of that FHA mortgage insurance, you're going to do that. Sometimes that's a year or two down the road. Sometimes it's 3 years. But either way, the points you paid up front are a sunk cost. They're gone. The FHA loans I'm writing right now, I'm writing the opposite of points. I'm writing with a rebate. For example, I literally have somebody in contract right now, and we're able to give this client about 1.5 points in credit. So $300,000 loan, $4,500 in credit at a 2.875. And the reason we're doing that is because we could give that client a 2.4 and they'd save $70 a month, but getting that extra $4,500 right now today, spending less out of pocket, benefits them because the 70 a month, we'll do some quick math here, 4,500 divided by 70, 65-month break even. There's a very small chance they're in this loan for 5.5 years, 5.33 years, whatever 64 months is. And so, answer to your question, I'd do it. And I would weigh, you're paying a point, you're paying a flat lender fee, and you're paying some title. So maybe in your scenario, it's $5,000 in total costs. And if your mortgage insurance is $250 a month, then you're saving $3,000 a year. So it takes you a little less than 2 years to break even. If you say, for sure, I'm in this house for the next 10 years, then go ahead, refinance, and you'll break even within a couple of years. And if any part of that is different, then you can reassess it. But I probably would. Right now, when we saw this little dip in rates, we're back around that 3% range without points, and you can get 2.75 paying a point-ish. I'd probably look at it right now. And so, yeah, you said your credit's back to 750. For sure. I would, I'd take a look at that and probably refinance it, especially, if your loan amount's 110 and your mortgage insurance is low, then maybe it doesn't make that much sense because that $5,000 in costs might take you 5 years to recoup. But if the loan amount's 300,000, 400,000, and your mortgage insurance is 250 plus, it's going to make more sense. It's all cost benefit, right? And that's what I'm going to look at when I'm looking at refinance for folks is how much does it cost you in loan costs? You're not paying it out of pocket. It's rolled into the loan, but it's still a cost, right? So that cost versus the benefit, which for you would be whatever the mortgage insurance is times 12 per year. And how long is it going to take you to break even? That's the analysis I would do. Are there any conventional loan programs that could be less than 15% down for a duplex? It would be owner occupied. Thank you. You know what, Chris? I literally just walked through this with a client today. And so on another screen, forgive me for looking over here, I'm running pricing right now because owner occ, it's 15% minimum. I'm going to run it through a pricer of a different lender just to see, because I gave this answer to somebody earlier. And I was thinking, are you my client who I talked to earlier? But I'm almost positive that 2-unit owner occupied, 15% down is going to be the minimum. There used to be Home Ready, Home Possible, which I think literally ended April 1st, 2021. Like as in 3 weeks ago, you used to be able to put 5% down, I think. And I'm fairly confident Purchase Home, let me run the pricer, that 15% is the minimum. I want to get you a real answer. So I'm going to do some pricing with a lender here on the second screen and see if they give me pricing at 10% down. We definitely got it at 15, and the mortgage insurance is cheap, cheap, cheap if you've got good credit. And the client of mine who asked about it today asked about conventional because they already own a home FHA. So if you don't own a home FHA and you're trying to buy a duplex with less than 15% down, FHA is your best option. If you already have an FHA, so FHA is something you cannot do, then yes, 15% is the minimum down. I just confirmed it. I ran it. I wanted to make sure that I wasn't going crazy because sometimes my head spins and I learn so much about loans on a daily basis, seeing new stuff. Some of the old stuff drips out the other side of my head. So 15%. That is the truth. Simon, thanks for joining us. New build pre-drywall walkthrough is this Friday. When should I expect completion? And when do I go into underwriting? I would talk to the builder because I wouldn't be able to give you a very accurate answer on when they're going to be done. But they should be able to underwrite the file. I mean, you could submit and underwrite a file any stage of the build process. And what they do is it gets underwritten. The file, is at the lender and it's approved. It's conditionally approved. They ask you for whatever documents they need. They can even send the appraiser out. The appraiser comes out and says the bathroom's incomplete, the kitchen's incomplete, and the finishes need to be put on. But subject to these things being complete, this house is worth $750,000. And then what happens is once it's complete, they order what's called a 1004D, which is a reinspection. They go out and reinspect and they go, yep, bathroom's done, kitchen's done, all the finishes are here. And they check that off and basically reinspect that things are done. And then that appraisal gets cleared. So hopefully that helped a little bit. But I would talk to the builder and say, when are you guys going to be done? Joey, what's up, my man? I appreciate you, man. You got a book on the way, one rental at a time. My buddy Mike Zuber and his channel. I know you follow both of us, and so Matt the Mortgage Guy swag is in the mail. I think UPS said you should expect delivery Thursday. So enjoy that book. Enjoy that Matt the Mortgage Guy swag. This is the favorite piece of Matt the Mortgage Guy swag right here. So it's like a bean bag, and you set your cell phone in it like this. See? And you can sit it when you're watching Matt the Mortgage Guy videos, right? See that? That's on the side. I don't know what it's called. It's called a toddy gear. And it just sits in there like that. That's friggin' cool, huh? Sneak preview of what's on the way, Joey. All right, we're getting some more details from Rob. $400K property, $268 monthly P&I, and it's a duplex. No refinances in New Jersey, but at the top of the chat, I've got this, which is a link. If you go here, mattthemortgageguy.com/great mortgage broker, quick form, you fill it out, you say what state you're in, directs it to a great mortgage broker who's in my network who is going to help you and serve you at a high level. If they don't, they in big trouble and they off the list. They're going to be fired. So check that out, and for sure they should be able to help you out. If your credit's 750 now, 268 monthly PMI, I'm going to do this for you right here. And keep in mind, 400K property. Wonder what you owe on it. 320 grand, we'll call it, because you say you got 20% equity now. Refinance. Pricing is going to be different because it varies by zip code. As funny as that sounds, like lenders price different. But I'm just going to see if my guesstimates were right, that 2.75 should be about a point. Duplex is going to be a little bit more expensive, but not too much. You should be able to get under 3%. And my guess is that under 3%, even if you go to 299, if you go to 299 with no 268 mortgage insurance, the principal and interest payment goes up by like $40, but you save 268. So let's call it 230 in savings. 230 times 12. You're saving $27.60 a year. It might cost you between a point and between some lender costs, $5,000. You're breaking even in 2 years. Plan on staying there long term. The refinance makes sense. That is my unbiased opinion. Go ahead and check that link out. And then, you owe $384. It's worth $485. Okay. Same advice is follow that link, connect with a great broker I know out in New Jersey, and they'll help you out. The refinance makes sense. If you're staying there 2+ years, it's a thumbs up. I come across so many scenarios that I'm pretty straightforward with people. Yes, makes sense. No, doesn't. Sometimes it's like, it's right on the border. This one makes sense. Thumbs up, move forward. The end. What's up, Bill Phipps? How you doing, my man? Funded by Phipps. This guy's a fellow loan originator. On a new home build, when do you lock the interest rate? Is it at the time you make the deposit when the construction is complete? This is a common question, Bill, and I appreciate you throwing me some softballs here because with a lot of people in contract on new builds, this is one that comes up really, really often. Let's say you're in contract on a new build and it's going to close in September, and we're in April. You've got 4.5 or 5 months until it's complete. You generally can lock. You have many options, and a lot of the builders lenders are offering these 180-day locks. And I know more than your average Joe because I get comments galore. I mean, I've got videos on new builds, right? And so they offer these weird terms where it's like you lock in this rate and you add a quarter to the interest rate. And so maybe 3% is the rate, but then you add a quarter, so it's 3.25, but you get it locked over 180 days. Not that bad of an idea, to be honest. So if you're in contract on a new build and you want some certainty about what your rate's going to be, how much your payment's going to be, I would highly suggest looking at that 180-day lock. If you are more of a gambler type, a gambalero, they would say in Espanol, then maybe you wait until you're 60, 45, 30 days out and try to lock then because, right now, if I locked for 30 days, let's say that 3% is what I could get. But that's a 30-day lock. If it was a 45-day lock, it might be 3.05. If it was a 60-day lock, it might be 3.1. For a 180-day lock, it might be 3.25. Longer locks are more expensive. More expensive equals higher rate. Or you pay a point for the 3% versus paying 0 points for the 3%, if that makes sense. So it's all preference. My thought is in the short term, like the next couple months, rates are probably going to go higher. I don't expect rates to go lower. So in this specific scenario, September close, I would lean towards the 180-day lock. Just one man's advice. Random friggin' dude on YouTube, happened to be a mortgage broker, NMLS number 1088993. But that's my advice and I'm sticking to it. Thanks for the question, Bill. Appreciate you. All right, Rob. Cool. I'm glad. Let me know if you can see the link up at the top of the chat because I'm doing this through StreamYard. And so I'm not looking at YouTube chat. I could probably go to YouTube and look at it. I'm telling you guys, mortgage, I might be decent at, but tech, not really my thing. Live now. Am I able to look at the comments live? Okay, mute it. Do it there. Yeah, so on your guys' side, I'm guessing you can see that link. Okay, and it actually shows up as a link. Okay, cool. It's probably distracting to see myself over there. I'm not going to do that. All right, Rob, you're there for 10 years. Proceed with refinance. All right, Joey. We'll give you your actual FICO mortgage scores, 245. I tested out to confirm the accuracy since my credit was run for mortgage refinance. The mortgage scores were the same when hard pulled as my FICO and extra credit mortgage scores. Well, that's good to know. Warning to everybody in the world, you are going to get a score from Credit Karma. You're going to get a score from your credit card. You're going to get a score from Bank of America. You're going to get all these scores. You're going to contact a mortgage broker. We're going to pre-approve you. We're going to run your mortgage scores, which is a different algorithm than Best Buy retail scores or car dealership scores. And you're inevitably going to be like, Matt, I don't like you because my credit score came back as 692 with you. Bank of America says I'm 737. Mortgage scores, totally different animal. Lenders are lending you $750,000 versus, Best Buy is going to give you a card for $500. So as you would imagine, it's different algorithms. Ultimately, I don't make the decisions. I know you're a nice person. I know you pay your debts on time. It's a score based on different stuff. And so it may come back different. But Joey's saying that there's some stuff you might be able to pull with my FICO and extra credit mortgage scores they're accurate. So that's good to know. That's cool. Armando, thanks for joining. Appreciate you joining us. How important is it for lenders to see positive cash flow in rental properties? I have 4 doors. I want to get ready for my 5th, but I've been breaking even or showing losses for tax purposes. Welcome to the club, Armando. Just about every investor is going to be break even on taxes. And the good news is that even if your bottom line shows break even, lenders get to add back depreciation, taxes, and things like that to where it might show break even on taxes, but we're able to use $500-$600 a month in rental income. But the key is to not be dependent on that rental income to qualify. Let's say you've got a W-2 job that pays you $80,000 a year, and you've got these 4 rentals that break even, or maybe they just show enough to offset what the payments are for at least not be a $800,000 a month quote unquote loser on paper, then you should be okay. But any good mortgage broker, especially if you're getting ready to buy number 5, make sure they have everything. Let them pre-approve you and tell you before you get into contract, okay, based on your W-2 income, all your rental properties, here's what you'd qualify for. And it's pretty easy to run that Schedule E rental property income through an Excel spreadsheet that lenders use and say, here's what the underwriter is going to use for income. Here's what your W-2 income is. Here's what you're going to qualify for, and go from there. So you are not alone. Many real estate investors are not in the business of throwing all their profits from rental properties straight back to the IRS so they can go frivolously spend on things that may or may not be productive. All right, rant over. All right. Thank you, Rob. You see the link. Cool. If anybody is looking for a great mortgage broker, whether it's in California where I'm at or any other state, go ahead. The link is like 5 or 6 questions. You get a sweet little video from me, and then it will direct traffic. New Jersey, here. Florida, here. Michigan, here. Texas, here. And connect you with somebody who's in your state. What I've learned is I could go out and get licensed in every single state. Texas and how they do property taxes and how some of their mortgage things work, totally different. Florida, different. I'd rather just be a California expert and be really good at it. So if you're in California and you're working with Matt the Mortgage Guy and team, we know our SHIT. And if you're out of state, I'm going to connect you with somebody who knows their SHIT. What's the soonest someone can refi out of FHA to conventional? Is it 70% LTV for a duplex? If you're pulling cash out, it's 70%. If you're just doing a rate and term, you should be able to do it at 75. It also depends on if you're occupying it. If it's your primary residence and you're living in one side and renting out the other, then you should be able to do a rate and term conventional up to 80% LTV. If you're doing cash out, or if it's an investment property and investment property, rate and term 75%. Cash out investment property 70%. Cash out primary. Let me see if I can get pricing at 80%. I got my cheat sheet over here. I'm pulling pricing. Nope. Cash out if you live in it, primary. I think it's 75. We're about to see. Big bucks, no whammies. Yep. Man, I still got it. My brain is getting old. It's getting worn down, but I still have a little bit of mortgage knowledge up there. Before I forget, I want to mention to anybody on here, if you're looking for a side gig, I think it would be really useful to catalog some of these live streams where if I talk about investment properties from minute 25 to 26, and then I talk about cash out refinance on a primary from 26 to 28. If somebody wanted to do that and like sit through a live stream, they're like, hey, I'm going to watch it anyway. I'll just go through and catalog that. We could work out something, right? I don't know if it's going to be any great wage, but like $20 per video or something. If you want to do that 4 times a month and make $80 to throw at your principal, or $80 to be able to get an extra 16 Starbucks per month, let me know, because I think it would be valuable for people watching it on replay. I could probably find somebody on my team, but I don't know if they want to sit there for 2 hours and watch it. I feel like there's somebody out there that's like, oh yeah, I watch this things. I would just take notes as I'm watching it. It wouldn't take me much extra effort, and be happy to do that. So let me know if anyone's looking for a job. It doesn't pay much. It'll be fun, I hope. I guess, did I answer that question? What's the soonest? When you refi out, if you do it within 6 months, whoever did your loan is going to get an early payoff. So it's going to be bad for the original lender. So out of respect to that original lender, I would say wait 6 months. But there's no real rule except for that if you bought it FHA, maybe you bought FHA and it increased in value. You did some renovations, or maybe you bought it FHA and you came into some money where you want to put money down and then refinance it. But whatever the case, there, no real hard and fast rule. Probably wait 6 months, just so that you don't kind of screw that original lender. I wanted to get into a new build that is not going to be ready until probably December. I was told I can afford the home today at current rates, but I am close to the max of my DTI. This is a strong case for a long lock period, because if you qualify right now and you've got to pay extra for 210-day lock, then you probably do it, because worst case scenario, you put in some sort of deposit. 3 months from now, 4 months from now, rates are 3.5 and you no longer qualify. Unfortunately, I've seen inventory come back on the market from builders from people falling out. And I think this might be part of the reason. Even this last February, March stint where we probably went from 2.6 to 3.25, people fell out of contract. And I think it was this. I think it was very tight on DTI, no longer qualify, and avoid that by doing a longer lock period, I think is probably the best bet. That's my best advice there. How hard does it get to prove for a refi cash out on equity loan when on disability? I have a lot of equity. Shastina, thanks for joining. Appreciate the question. I think any refinance, any loan, it's all math. So it's your income versus your debts, and your debts include the mortgage. So if your disability is $2,100 a month and you've got no other debts and your mortgage is $900, then you'll likely qualify. If your disability is $1,400 a month and your mortgage is $1,900 a month, and you've also got a car payment, you've also got credit cards, then you're going to have a very hard time getting approved, because just general purposes on a cash out refi, let's say 45% is the max debt to income. That's going to mean if you've got $2,000 in disability income, max between your mortgage and all your debts is going to be 45% of that, $900. And so if you've got a $300 car payment, $150 in student loan payments, credit card debts, and your mortgage, no way that's fitting in that $900 45% max DTI. And so in that case, very hard. In the case where there's no debt, your mortgage is very small, and you've got a good amount of disability, then you're in good shape. So long-winded answer, but hopefully that helps. Utilize Prop 19, buying it owner-occ from parent, and I will occupy it too. If you're buying it owner-occ from your parents, what this sounds like, do a gift of equity transaction. They're allowed to sell it to you. Hopefully you live there. This is something that I think most people don't know about. I've got such an old video. I hope it's still accurate. But gift of equity transaction is something that I've been doing a ton of. And you can do it FHA, you can do it conventional. And for your situation, Chris, let's call it random notes over here. Let's call it a $400,000 duplex. I've got no idea. But your parents are selling it to you, and they're saying, all we really need to do is net $320. That's all we care about. They can gift you through the transaction your 20% down. You'll come out of pocket zero. That 20%, that $80,000 on the $400,000 purchase comes out of what they net, right? And so they net $80,000 less. So it's a $400K sale on $400K sale on paper, but the $80,000 that they're gifting you comes off of your cash to close, 20% down plus closing costs. Maybe you just bring in the closing costs. You're bringing $8,500 or whatever that is. That's a way to do it, and you can still utilize. You talk to the title company and you get the tax basis to transfer to you since you're the kiddo. That'd be sweet, man. I would recommend talking to a local mortgage broker and asking them about gift of equity transaction. If their eyes gloss over, they don't know what you're talking about, then you're talking to the wrong broker. If you follow the link and talk to the broker who's in my network, 100% guarantee they know what you're talking about, gift of equity transaction. That's how you do it. When it's parent to child, you write up your own contract. You don't have to deal with multiple offers in this market. Gift of equity is the shiz right now, for sure. Mortgage qualification scenario. Person worked in the industry for 20 years. Then she retired due to marrying a retiree. Then divorced, and the person is starting a realtor career. Here's the answer that will answer the question for more people, is that if you start a new career that's commission, like a real estate agent, it's part-time, or it's variable, or it's anything that's uncertain, anything that's non-salary, the lender is going to want 2 years of history. There's no real way around it. And I would not listen to anybody's advice who sugarcoats it and tells you that, like, oh, no, we can use 1 year, we can do this, we can do that. More often than not, you're going to get into trouble, and it's you need 2 years, because the lender has no idea with variable income how much you're going to make. The only thing they go off of is if you work hourly, or you work anything that's variable, or it's commission based, or it's anything that's varies from month to month. They want a 2-year history. Then they say 2021, you made 42,000. And then 2022, you made 58,000. So I'm going to combine those. It's 100. I'm going to divide that by 24 months. That's what we expect you to make, because that's what history is the best indication of future. I don't know, whatever it is. That's how lenders do it. And so near impossible to get a loan until you've got 2 years history. If anybody tells you different, run for the hills. Oh, check this out. Your follow-up question. I didn't even read it. Yes. 2 years for sure. And this is a question that comes up pretty often. What if she's got assets and savings? Very nice person, 800,000 in the bank, has made every payment on time in the world, owns 4 dogs and treats them really well. Like all the stuff that people tell me. Unfortunately, Fannie and Freddie and the guideline makers of the mortgage industry don't care about anything except for like their guidelines. And you got to fit in their box, which means self-employed, variable income, any of that stuff, 2-year history. Here's the time when you don't need 2-year history. If you've been working for 7 years, or I'm sorry, rephrase that. The only time we're not using a 2-year history is when someone's been in that same profession for more than 5 years. If you've been a realtor for 7 years, and we can show that, or you've been self-employed for 7 years in the same industry, we can say, well, the underwriting system tells us we only need the last year. We can look at just 2020 because you've been in this for 19 years. And we trust that, it's fairly stable after 19 years, right? So we can look at just 20. And that's, the findings from LP, which is the automated underwriting system, tell us, okay, you can only use 1 year. Oh, the questions are rolling in. I love it. I'm gonna speed answer some of these. I'm a senior citizen. I would love to downsize, but no inventory, so I stay put. It's a good question, Zita, and I feel you. This is something that's super common. I love a comment like this because it shows that like the data we see and the information we get is accurate. There's plenty of senior citizens that instead of downsizing and going through the hassle that is selling your house, which is fairly easy, but then competing against 20 offers and trying to buy in a market that's got so little inventory and it's so hard, is causing somebody like Zita, who's a senior citizen, to say, you know what? I've got more house than I need. I don't need 4 bedrooms, but it's too hard for me to sell and buy. And so I'm just going to stay put. This is super common. And I wish I had an answer for you, Zita. What could happen is if rates go up to 4%, the buyer demand is going to wean a little bit, and then it's going to be less competitive. When it's less competitive, it's going to be a little bit easier for you to bid on that 2-bedroom, 2-bath condo that's closer to your grandkids and that allows you to, sell this 4-bedroom house. And so maybe that happens next year. I'm not exactly sure, but I really appreciate your comment because it's supporting the data that we're seeing and some of the stuff that we're hearing where people aren't moving because they just it's too hard. I have 22 income disability and 2 renters. Unfortunately, if you're talking about renters in your primary residence, we can't use border income unless you've shown it on taxes. And even then it becomes kind of hard. So run that by a lender in your state and have them vet it for you. If you file taxes on it, you've shown, history, and you can show, I think they want checks for like the last 12 months. Someone's paying you $400, someone's paying you $500. If you filed it on taxes, which I'm not going to judge you if you haven't, because most people wouldn't. They're going to need that to be able to use that income. And maybe, if your only debt is that house equity loan, depending on what part of the country you live in, if your taxes and insurance are not that high and the home equity loan isn't that big and you're only looking to do a cash out refinance to 100,000 or 125,000, then maybe you've got a shot with that 2,200 income disability. So you're saying there's a chance. That's what I'm saying, Shastina. Well, they don't need all the equity, bro. Tell them to hook you up, man. So if you live there for more than 6 months, you can do, what's the number? It's 3.5% with FHA if you've lived there for at least 6 months. I, I think my YouTube video says how much it is, but it's like 4 years old. I've already forgot that information. But yeah, I mean, you could set it up however you want, and they could put the price at 400, do a gift of equity of 5%, then you come with 10%, something like that. Um, and I'm sure gift of equity works on a duplex. See, this is the part where you're like, no matter how long you've been a doctor, there's things that you got to look up on the computer. No matter how long you've been in loans, there's questions where I'm like, man, I did that 4 years ago, but I've done 900 deals since then. I don't remember. Shoot me a message if you want, Chris, and we can dig into it. But I'm sure there's something. It's an $800,000 property. Well, come on, man. They could sell it to you for $720. They probably only owe $500. Take that $200K equity. They could buy a nice place in, Tennessee or something. Cash. Tell your parents to give me a call. I'm going to tell them to set you up. All right. I'm going to tell them to hook up my buddy Chris. Except for that you're a Lakers fan. I live in Sacramento Kings. All my Kings stuff is over there. It's in some of my videos. That's all right. I won't judge you. How can you guarantee you get 10 rental properties in your name? Also, how much income do you need to make 10 rentals, and how much cash flow for properties need to get 10 rentals? This is a very complex question, my man, Dom. I would have a local lender kind of coach you through the first couple. And I've got plenty of folks that I've worked with where, they buy their first and their second property, and, 18% over 32% is their DTI. And I remember doing this with clients of mine where, as we got up to, okay, now you're 34% front end and 42% back end, we started to creep up towards the 50. I gave them an idea of what they're going to need, but there's so many variables. If you've got a W-2 job, which I really encourage people, even if they're building their portfolio, to, if you don't hate your job and want to jump out of a third story window every day, then keep it, because it allows you to continue to scale and buy these properties, and you get the best financing. Because once you leave that W-2 and you're just dependent on Schedule E rental property income, or self-employed income, which you're writing off a vast majority of most of the time, it becomes harder. And so ideally, you've got a W-2 job that can help support most all of those rentals, as long as those rentals are break even-ish, right? And not like a super drain and negative $1,500 a piece or something, but way too much in there for me to dig into. I'm going to skip down to your next one, then I'll jump back up to some other questions. But how long does it take to be considered a first-time buyer if you purchased a home 5 years ago to get the Biden 25K credit? First and foremost, the Biden credit is not even close to a bill. It's just a draft. Secondly, what the first draft said is that you not only have to be a first-time buyer. Considered a first-time buyer is no ownership in the last 3 years. So if you bought a house and then sold it in 2017 and you haven't owned since, you're a first-time buyer. But that draft is saying you have to be a first-generation buyer. If your parents own a home, you don't qualify. And so that's part of it. The other part of it is this thing isn't even a bill yet. And so I would not hold my breath, and I certainly wouldn't wait to buy something 9 months or 10 months from now when this is enacted, because you'll pay $60,000 more for a property, but you'll get $20,000 in credit. That's my 2 cents. Keep the change. Got a call locked in for tomorrow at noon with a mortgage person. Thanks for the links. See that? Just connecting people and homes one loan at a time. That used to be my tagline back when I was early. If anybody's got a better tagline than when you're ready to apply, call Matt the mortgage guy. Let me know. I think that's a good one. Yeah, I've got this thing where I don't work with Lakers fans, but no. All of California. I'm doing all kinds of stuff in LA County, Orange County, San Diego, San Jose. As you can imagine, with YouTube, people are contacting me from all over. So anything in California, happy to help Chris. I send me an email, matt@mattthemortgageguy.com. I don't want to put my calendar link out here for the whole universe, but I'll send you a link to my calendar. We'll jump on a 15 or 20-minute call. I'll coach you on how to tell your parents, listen, I've been a pretty good kid all my life. And I know you guys want to move to Montana and see the great open sky. Just give me a little gift on the way out. Sell me the $800,000 house for $800. Just a little gift of equity, little 5% of that, little 40 grand. It'll help me with the down payment. It'll be an advance on what you guys are going to give me in your will, something like that. I don't know. Yeah, matt@mattthemortgageguy.com. Shoot me an email, man. I'm happy to help. Is the investment loan for single family home still available? If it's still available, what is the cost? Thinking of buying the investment house for the next 3 months. Investment loans are definitely still available. And I talked about this in length on other videos. Every Wednesday, I talk with Mike Zuber on One Rental at a Time, a great channel where he talks about investment properties. He's got 180 units or so portfolio. And there was an announcement that Fannie and Freddie were limiting what percent of loans could be investor loans coming from lenders. So any given lender out there had to send 93% of their loans owner occ, and then only 7% could be second home or investment property. And so what this did was some lenders start to get more strict on their underwriting criteria. Some lenders got more, loan level price adjustments means got more expensive, but they're still writing them. And to be completely honest, there's some lenders that have put very little in terms of loan level price adjustments. So they're not charging that much more. I did some pricing for somebody who was on here last week, and we looked at 30-year fixed, great credit, 25% down, investment property, single family. It was something like 3.6% without any points. Again, not an offer, just some guy on YouTube talking, but 3.6% on investment property, pretty darn good. And that was the pricing at the time. It should be fairly similar today. NMLS number 1088993. Why did I just blank on that? 1088999. What is my NMLS number? I'm gonna look that up. Oh man, I must be getting tired. Okay, you're a business owner for 7 years. Hopefully your CPA is not too good, because when they're too good and you're a business owner, then your net income tends to shrink. I know people that have top line, 2 million, bottom line, 22,000. Then it becomes hard to qualify. But in your case, like I talked about earlier, if you've been in the business for more than 5 years, you show that in business for more than 5 years, more often than not, we can use just last year's taxes. And if you're getting a loan in 2021, lenders are as strict as they've ever been with self-employed. We'll look at 2021. Let's say that your bottom line is 72,000. 6,000 a month is your income. We're going to ask for year-to-date profit and loss. So you show us the first quarter. The first quarter shows that you've got 20,000 in net income. We're going to ask for 3 months of bank statements, January, February, March. It's got to support that 7,000-ish per month, right? And if it doesn't, then we ask for like an audited P&L. It gets tricky. Self-employed borrowers in 2021, no matter what you hear, no matter how much people try to sugarcoat it, it's harder. So be prepared. But if you've got good financials, a good healthy business that's showing income, good to go. My sister has an FHA mortgage and has 20% equity in it. Her credit is around 650. Should she try to refinance conventional now or build her credit? I guess it depends on what her rate is. If she's like you with a 2.75, I would probably not. Primary, single family, 80% loan to value, rate and term, 650 credit. Stand by, Rob. We're getting some pricing. These are all guesstimates, not offers. I wouldn't mess with it. You're going to be like in the mid threes at a 650 score. mid threes and paying a half a point. So unless she's got an FHA that's like 4.25 or something, I would probably say work on credit, get it to 700 plus, then visit that. What's up, Shastina? Elk Grove, right down the street. Send me a message for sure. Matt@mattthemortgageguy.com. We'll see what we can do. I'm all about creative suggestions, Chris, especially in those cases where I've seen more often in 2021 than ever before, as you would imagine. It's hard as heck to buy on the open market. It's as competitive as ever. So if somebody works out something where they work out something with the seller, or in your case where the seller is mom and dad, like it can benefit all parties. You know, they don't have to bother with putting it on the market, cleaning it up, staging it, paying realtor commissions. And that's the thing too. Tell them like, listen, if you sold it for $800,000, you would have to get tenants out. You know, no one's buying a house that's tenant occupied in 2021. I can tell you that because it's like impossible to evict. So as an investor, no one in the right mind is going to buy a duplex where there's occupants that you know can decide, oh, new owner, me no pay no more. And eviction moratoriums continue and you get no rent for 6 months or 9 months. So they're dealing with that, right? God, I got to talk to your parents. On top of that, 6%, so 48,000, maybe 5%, so 40,000 minimum goes to the realtor, plus title fees, da-da-da-da-da. You know, they're better off just giving their sweet son, Chris, 50 or 60,000. I'm up in the number. It was originally going to be 40,000 gift of equity. Now I'm asking for 60. The more I think about it, I mean, you are helping them out. Yeah, see, 5 years of paying rent to these parents. They're probably charging you like a third of what they could get from somebody else. They're doing you the favor, but I'm not going to tell them that. I'm on your side. And thanks for giving me some love as a Kings fan more than a Warriors fan, because I've been loyal, dude, since the mid 80s when grandma used to take me to basketball games, and we were so terrible. So terrible. Then comes 2002, and DA's got to just like, it's a sore subject, man. We were freaking robbed. And you know what? I'm going to be good. I'm not even going to charge Chris extra for this. But how do maybe I'll do this. I'll put this link back. Copy. This link should be in the comments for somebody who's asking about the link. Right there. Ba-bam. Yeah, this is very sore subject, 2002. Kings were robbed. I put it down in the, oh, you're right. I should put it in the description. Do I know how to edit this? I don't think I do. I'll put it in the description afterwards, but for right now, it's in the comments. I just threw it in the comments. Stand by, everybody, while I try to put it in the description. I'm not a tech genius, but I might be able to figure this out. We'll see. Go to YouTube Studio. Go here. Go to edit. Edit title and description. Man. Get started. And link and save. For a guy who's not very good at tech, getting pretty proud of the 40-year-old me. Look at that. All right. Link in the description. Nailed it. Thank you, Chris, for that non-mortgage question. Do you have any rewards credit cards? P.S. To those looking to improve your credit scores, having lots of cards and managing them at very low can greatly increase scores. I have almost 20 cards, but carry no revolving debt and have 750 plus scores. If you're able to, I think you can do that, Joey, with like 5 or 6. I too am a big believer in getting 1.5% back. All the business expenses I have go onto a credit card and I pay it off every month, so that over the course of the year, the monies that I spend on the cool Flowify software, all the cool stuff that makes the loan process super easy and amazing for anybody who works with me in California, all that stuff I get 1.5% back on, because I spend lots of money on some cool software. I agree. I don't know if you need 20. And I think honestly, my honest advice is that most people, Joey, with 20 are going to get very overwhelmed and lose track and then miss a payment and then all for naught, right? They get minus 60 points because they missed a payment on card number 19 that they didn't know that they had. So yeah, I got 5 or 6. I don't keep a revolving balance. A cool trick that I learned is that if you have 6 cards like I did and you don't ever charge anything on any of them, because business card is in my business name and so it's not showing up on my personal credit, that can hurt you as well. You have to actually be playing the credit game, right? And so go ahead and use the card, buy lunch, buy yourself, treat yourself, and then pay it off, but have some action. What's the key to getting the lowest interest rate on a cash out refi on a rental property? Should I search a bunch of banks or credit unions, or how do you get them to send you the good faith estimate? You can talk to honest mortgage brokers. If you were in California and you said, here's my mortgage statement, I'm trying to do a cash out refinance to 75%, I'm going to send you a loan estimate. I'll show you what I send people. Refinance scenario templates. Let me take the name, the address. I got to rename it. All right. I just picked the first one I saw. It's going to be old. It's not going to be an offer. And it's going to show you, though, what I send to folks that are looking for an estimate. Share screen. This one. All right. Man, this is hard to see, right? But this Excel spreadsheet I send people is literally like, it looks like a loan estimate. And it's got all the things that a loan estimate would have. We created this template to kind of show folks. And so somebody should be able to send you something like this. And I'll tell you, here's what you want, Dom. Let's say you talk to your bank sucks. They take forever to close the loan. They're more expensive. So I just saved you time talking to them. Talk to a credit union, talk to a direct lender, talk to a broker. The broker is going to be the best, but you want to see the other two just so you can compare. And ask them to send you something, no matter what they send you, because everybody's stuff looks different. Here's what you're looking at. Here's your loan amount, right? In here. And I know it's hard to see even if I zoom in, but down here under loan costs, if they send you a loan estimate, great. Most people are just going to send you something that's not a true loan estimate, but it's going to be something like this. All these other fees are all third-party stuff that shouldn't vary. Like prepaying into your property tax and escrow account is going to be the same no matter where you go. And so the only thing you need to look at is this lender's offering a 2.875. There's 0 points attached to this loan. There's a 1055 flat fee. They can call it underwriting. They can call it admin. They can call it whatever they want. And then they might have a processing fee. I personally don't charge a processing fee on most of the loans I do. 1055 underwriting fee is paid directly to the lender, and then 0 points. This is important too, because you might get a lower rate somewhere, but then you look and there's $4,700 or $5,800 in points. Not that good of a deal. For this specific client, I sent them this estimate where I said 2.875 is 0 points, 2.625 is $3,700, right? So that was on this loan amount like 1.4 points. And then side by side with a 15-year. You want a 15-year at 2.39, paying 0 points, Do you want it at 2.125, paying a little bit more than a point? And so something like this is probably what you want to look for from whoever you're getting loan estimates from. And buyer beware. I've made 100 videos on, the longer you look, you might find the more desperate and the biggest liar. But yeah, I think that's all the advice I have for lowest interest rate on a cash out refi on a rental property. I would say if you've got good credit and it's a single family and you're going 75% cash out, it should be high threes without much paid in points. That's my guesstimate. Whoops. Didn't realize we're still sharing that screen. Ba-bam. All right, there we go. What's the secret to refi a loan before 6 months? You can do it. It just screws the person who did the loan with originally. If you bought FHA and then 2 months later you refinance conventional, I don't know how much has changed and why it would be like a FHA purchase and then a conventional refinance, but you certainly could do it. Owner-occupied duplex, want to refinance. Is the rental income included as income also? Yes. And depending on how long you've owned it, if you bought it recently and, let's say you bought it in October of 2020 and you just got tenants in it in January, if there's no history of it on your tax returns, lender's going to use 75% of whatever the lease agreement says. So you're renting the other side for $1,600, lender can use $1,200. And that's just your income plus that $1,200 on the income side versus debts on the other side for debt to income ratio. If you've had it for 4 years and you're refinancing it, then they're going to go off whatever your tax returns say. So hopefully you file it on your tax returns. And this is true for rental income. This is true for self-employment income. Every, couple days I have a conversation with somebody who goes, no. My self-employed business, $10,000 a month. I will show you my bank statements. Lenders are not going to do anything with bank statements on conventional financing. They're going to look at your tax returns. Whatever your tax returns say, as far as net income goes, that's what they're going off of. If you want to do a bank statement loan, it's a totally different product. And then they'll look at your bank statements. But otherwise, conventional products are going to be using what shows up on your tax returns. Builder said completion is July. I wonder if my broker knows about the early completion. My broker said rate lock in July. Yeah, you definitely want to look at that, next month in May. Look at 60-day locks. And then have the conversation with the current broker you're using and say, what do you think? Should I do a 60-day lock? How expensive is it? The 60-day locks I'm seeing aren't that much more expensive than a 30. I would probably give you the advice that if you like it, lock it. And let's say in May, you're 60 days out. One, make sure that you're 60 days out and the builder's gonna be able to complete it on time so you don't blow that lock. But if you are 60 days out and expect to complete in 60 days, then you look at the 60-day lock and it's 3.15% to lock it for 60 days. They can tell you what the pricing is on the 45 and the 30, and it's going to be slightly better for 45 and then slightly better than that for 30. But if you wait until you're 30 days out and then that 30-day lock is 3.25 because rates have ticked up, then you're worse, right? So it might be a if you like it, lock it type of scenario, and probably what I would do. Eduardo, thanks for being here, brother. I enjoy doing this. What's the usual time you have to wait to refinance after getting a loan? Also, can you talk about the clauses attached, specifically owner occupied? You can really refinance whenever. There's no timeline on how soon you can refinance. Like I said earlier, if you buy a home and refinance within 6 months, that original lender is going to get an early payoff. And wherever you did that loan, they're going to be forced to basically refund whatever commission they made off of the loan. So if you enjoyed your experience and you like the person you did the loan with the first time, wouldn't refinance within 6 months because it's going to hurt them. in the case where there's a builder that was super aggressive and forced you to use their lender and they were complete pricks about it, then go ahead and refinance in 3 months and sleep fine at night knowing that you took the $7,500 credit from the builder's lender and then you refinance out of it in 3 months, got yourself a better rate. I don't know if that's kosher advice, but it's just what came to mind. I have 60K, so them giving me 60K would put me at 15% NIDA. See? Just that easy, Chris. So yeah, I knew you were paying cheap rent, man. Yeah, and you upgraded that stuff. You got to point all that stuff out, man. You got to have like a laundry list of things you've done so that when you go to that meeting with the parents, you can schmooze. Thanks for the question, Steve. I appreciate everybody who's here, and I really enjoy answering these questions. This is as fun for me as it is informative for the folks watching. So I'm going to continue to do this until it's no longer fun. Then I'm just going to quit. I'm going to be off YouTube. You guys can be like, where'd Matt the Mortgage Guy go? And I'll be on some island somewhere. Can you refinance while in forbearance? I have 6 years left on a 15-year 2.875, 108K left, paying $2K a month PITI. In forbearance since November, Fannie Mae. Most all lenders are requiring you, they all require you to exit forbearance. They used to, some of them say, not only have to exit forbearance, but then make 3 on-time payments. Now it's just for most lenders I work with, once you exit forbearance, you can refinance. And so I guess I would look at what you're trying to do. If you're trying to refinance into a 10-year or a new 15-year or do cash out or do something, then maybe you exit forbearance. Whenever I see a loan amount that's relatively small, in your case, $108,000, you've got to see quite a bit of benefit for it to be worthwhile. And let's say that you said, I want to refinance in a new 15-year, and a new 15-year might be 2.25. Well, 2.875 to 2.25 on 108,000, half a point, $500 or $600 a year in interest savings, not moving the needle that much, right? And so loan costs, like the title fees and that stuff, are flat fees generally. And so if you're talking about $3,000 in fees on a $500,000 loan, it's a lot less impactful than $3,000 in fees on a $100,000 loan, because then you've got to be in this thing for 5 years to break even. And so look at that before you exit forbearance, because maybe you're just better off if you stay in forbearance and save up that money and then just stick in that loan. But I guess, you could have some need for like a cash out. You could have a need that, you want to do a new 15-year and lower your payment by stretching it back out to 15. You want to go to a 30-year and have a lower payment, or you want to go to a 10. I don't know all the stuff. Muy buenas noches de la ciudad de Mexico. How do you say that? How do you say Mexico City in Spanish? Hace como 17 años viví en Querétaro. Es como una hora de la Ciudad de Mexico. Is that how you say it? Gosh, it's been 17 years since I studied down in Querétaro, but thanks for saying what's up from Mexico City. I'm glad I got some of my paisanos down there showing me love. Still speak a little bit of Spanish. It's rusty, but I was there for about a year and a half. Had a great time. And, when people see this güerito speaking Spanish, it's a sight to see. Thank you, Simon. How does one get an investment property loan after buying first home? Do I need to increase my income? Always helps to increase your income. I can tell you that. Don't tell nobody. Don't tell nobody about that perfect Spanish, because nobody on my team speaks Spanish, so it's hard to work with Spanish-speaking clients. But in California, you best believe I got some awesome Spanish-speaking clients, and they refer the heck out of all their family and friends. Sorry. Skipping ahead back to this one. Here's how it works when you're buying investment property is you've got the debt to income ratio, right? And you make $5,000 a month. Your mortgage on your property is $1,500 a month, and you've got other debts that are $500 a month. So $5,000 versus the $2,000 in debts, which is mortgage payment plus other debts, right? And so that's a 40% debt to income ratio. When you buy the investment property, now we're adding projected rents from the property to your income side, and we're adding the debt from the new mortgage to the debt side. So in your scenario, I said 5,000 in income and 2,000 because you got a $1,500 mortgage and 500 in debts. You want to buy a rental property that's another $1,500 mortgage, but it's going to rent for 2,000. We can use 75% of those projected rents. So add 1,500 to your income side. So 5,000 plus 1,500, 6,500. 2,000 in current debts plus current mortgage plus the new $1,500 payment on the rental property, 3,500 on the debt side. 6,500 versus 3,500, no bueno, since we're using a little bit of Spanish, right? Conventional loans, you want to be under 50%. And so you're close, but you're not there. So answer, get your income up by $1,000, make $6,000 a month, then use that projected $1,500 a month income. Now you're 7,500 over 3,500. Now we're in business. So maybe your income's there. Maybe you don't need that extra income. It certainly doesn't hurt, but that's how it's going to work. Linda, I liked your video on the possible 25K program. Financial education is key. It's a shame if this does pass, the inventory is so low. Your ideas about the tax incentives for investors. I appreciate that, Linda. And I had a great conversation where I agree with what they're trying to do. And I agree when there's a huge disparity in home ownership between different demographics. Like, let's help the folks who, it's no secret, right? Like, stats are stats, data is data. If Black, Hispanic, Native American, Asian homeownership rate is lower, help them out and let's help equal that. But to your point and to the point I made, if folks don't have financial education, if you've ever heard Kevin Hart talk about what he's doing with Chase, where he's going into like Baltimore and inner city and helping, folks who are generally not very financially educated, like from the hood, right? That's the stuff that is needed more than anything, because you give an incentive to somebody who, like we've all seen, an 18-year-old who makes the MBA, who has no financial education, can get paid millions of dollars, will lose everything. We'll be broke within 3 years of retiring from the MBA. There's crazy stats on that, right? And so same thing here on a smaller scale. You give someone a $20,000 incentive or $25,000 incentive to help them buy a house. If they're not financially educated, owning a home, there's maintenance, there's other stuff that goes along with it. You can get yourself in trouble real quick and lose the home. And then you don't help that equality equation where you're trying to get home ownership up for a certain demographic, right? To help equal the playing field, generational wealth type stuff. If I was in charge, man, be programs, be educating. That's my second channel, by the way, if I ever do it. First generation millionaires. when I was running today, I had that like feeling that that's my calling, helping people who generally don't have the education, educate themselves on financial literacy. Financial literacy is what is needed more than a handout. It's the teach a man how to fish that is needed. It's not give certain people fish, right? Because they're going to be starving 2 weeks from now. Man, I should run for friggin' office or something. $93,000, $8,000 a month, $650, depending on how much you put down. Let's call your mortgage $3,200 a month. So you're sitting on 40% DTI already. Go to your boss, show them your value. You're worth at least 110. You're on YouTube University right now, just bettering yourself. So yeah, it might be tight with adding depending on how much you put down and how much this payment is, right? If it's 3,200-ish, like I'm guessing, then it's gonna be tough to add an investment property to the mix. All right, you heard it here first, guys. Perfect Spanish from my buddy from Mexico City. And this guy lives in LA, so you know he knows Spanish when he sees it. You are welcome, NYC. Just bought a home for only $10,000 over list. Does that insulate you from potential crash? I plan on keeping it. Here's the thing, wise guy. I've said this in other videos, and I believe this wholeheartedly. Absolutely, very, 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 very unlikely that this home is worth less 20 years from now than it's worth today. So you've probably got a 3%, 3.1, 3.2, 30-year fixed rate loan. Your housing expense is fixed. You're good. As long as you can stay employed and add value to the market, then you're good. You're set. I can guarantee you, if your city is growing, like you say, rents are going to continue to increase. And so 20 years from now, someone's going to be paying $3,000 a month for rent in a house that you're paying $1,600 a month as a mortgage. You're winning. Homeownership over forever and ever and ever has always proven to be a good investment. So everybody who says like the market is overinflated, the market's going to crash, you're going to be fine. You've got a stable, 30-year fixed rate mortgage that's not going to change. You're in good shape. Oh, my buddy Kyle Seagraves, what's up, my man? Hope everything is well in your world with your fam, and for sure, we've got to schedule a live again soon. Love to chat with you. If you guys don't know about Win the House You Love, this guy is the GOAT of YouTube lenders. He's out there just spreading the word. He's got a cool, soft voice. He just will. If you've got worries about mortgage lending, just listen to him for about 20 minutes to calm down. Sometimes I'm a little bit energetic and I might get you a little bit anxious, but this guy, he'll calm you down. He's the man. Thank you for the super sticker. I appreciate it. Not only is it cool to send me a super sticker, but I get some serious clout when I go home to my 12, my 8-year-old, and I can tell them, listen, Daddy got super stickers on his live tonight, because kids these days know all about YouTube. They know all about super stickers and super chats and all that stuff. And so much appreciated. Let me know if I can help in the future, even if, I'm guessing you're in New York City. If you've got questions on that qualifying for the rental property, let me know. I've actually got a buddy, Ben Lavender, who I did some stuff with at a conference last year. He's out in New York City. He's a British broker. He's got a cool accent. It's just fun talking to him. He can set you up out there. And so, yeah, look at this, wise guy, 2.75%, 30-year fixed. You are set. Here's my point of view. I might be right or I might be wrong. The government is pumping money out into the economy with like a machine gun, right? No doubt we're going to see inflation. No doubt gasoline is more expensive 5 years from now. Rent's more expensive 5 years from now. A bag of Cheetos is more expensive 5 years from now. Your mortgage is 30-year fixed. The best way to hedge against inflation is to have fixed rate debt. This debt that you have, you're paying the same principal and interest payment 20 years from now than you are today. That is the biggest gift that anyone could ever have versus inflation. So you're winning. You said to get a conventional loan, they go by what your taxes say, but what about income that is not included in your taxes? I know all about IHSS income, and they definitely give you a W-2. So that should show up on your taxes. If you do it part-time or it's not enough to have to file for taxes, then it probably wouldn't be enough to qualify for a loan anyhow. But I've done loans for lots of folks, and maybe one of the two does IHSS and the other one works another job. IHSS income for sure shows up W-2 income, at least in California. It might be different in different states. In California, you get a W-2. And so in-home support services, for anybody who's wondering about that, you're caring for somebody in the state is paying you to care for them. So thank you for that. That's much needed, much appreciated. I've purchased, renovated, and sold hundreds of properties starting 2002. I've never seen anything like this. Haven't bought a thing in over a year. That's a wild, wide world out there. And I think that, I don't think it's been talked about much, but my mortgage broker day job, my real estate investor side hustle, these friends, these folks, these circles I run in, and then this world that I live in that I do as a day job, I think are two different things. And I think that I'm analyzing deals, I'm writing offers on deals as an investor, but finding deals that pencil is harder than ever, right? As an investor who is patient and doesn't need to buy a deal just to buy a deal, I'm like you, Yankee, where it's been 10 months since the last deal was purchased. And so I think that is probably different, though, than somebody who's buying a primary residence they're going to live in for the next 20 or 30 years, because they don't need quote unquote cash flow, or they don't need cash on cash return, right? They're looking for, this is the school district where I'm going to raise my kids. If I have a stable 30-year fixed paying X amount per month versus the X amount or the Y amount that I'd pay in rent, that it makes sense. And so in that case, I mean, I have conversations with folks too, where you're paying 40,000 above ask. It might be 20,000 more than the thing appraises for, but does that matter 20 years from now? I mean, I guess you could say the same for some rental property stuff, but I really think that it's two different conversations. But with that being said, there's still deals to be had. They're just in different places. I think right now where you're seeing a little bit of distress is mom and pop landlords that have never seen or felt vacancy or tenants not paying rent. And they're like, get me the F out of the real estate game. I want out. And some stuff that I've seen go to investors where they're done. I just want to break even and get out of this place. And so investor buddies of mine are finding great deals where, they know how to deal with an eviction, and they know how to deal with tenants. And if they get it at X price, they can ride out 6 months of eviction moratorium and then deal with that as it comes. So can I still get a conventional loan? You were asking about the IHSS income. If you don't have any income on your taxes, you are not going to be able to get a conventional loan. So yeah, I think that's it. I mean, all loan guidelines go back to income versus debts, and it's just a math equation. It's nothing personal. And so I would figure out what the monthly income is for IHSS, and then it's got to work to income ratio wise. Kyle is great. You are right. For anybody who's wondering, he's referring to Kyle Seagraves from Win the House You Love. Best lender on YouTube. I'm slowly making up ground though, so I just got to warn you, Kyle. I'm on your heels, buddy. I've only got 1/12 of the subscribers you got, but I'm on my way, buddy. Should I have my realtor join me at the pre-drywall meeting? I guess you could. I mean, what's going on at the pre-drywall meeting? I need a little bit more color to this on what you're looking for from your realtor in that pre-drywall meeting. With this government, I'm concerned that eviction moratorium will never end. Indefinite extensions. I mean, you're not lying, dude. They are kicking the can down the road. I just saw something today. Gosh, where was it? CFPB said on April 1st or whenever it was, avoidable foreclosures. We're going to do everything in our power to avoid foreclosures. We're going to make servicers and lenders do everything in their power. And if they're not doing everything in their power, we're going to come after them. They reiterated that today in something I read. And gosh, what was that? It was a reiteration of lenders, servicers better do everything they can to avoid foreclosure. And so the same thing's happening with evictions, moratoriums, and whatnot, where The saving grace in this is I know that a lot of mom and pop landlords were really getting crushed. They've come out with like 25 billion in rent assistance. As a landlord, you can apply for it your tenant's behalf. As a landlord myself, I'm always trying to be empathetic and graceful with tenants. Everyone's got different, situation. Even the tenants that are obviously using it to their advantage, they can pay, but they just choose not to. I mean, getting mad at it doesn't help anything. But I've got a couple tenants that are doing their best, right? And they're working with my property manager and saying, we can only do this much this month. Once we get the next round of stimulus, we're going to give you this much. And they've been trying. Those folks, I'm stoked that my property manager can apply for some of this rent assistance, and it can go back, I don't know how many months, but it should be able to get them caught up. And then you tell them, we applied for this on your behalf. You're all caught up. Do your best to maintain that, so in the future you don't have, eviction on your record or anything negative. And I think that tenants appreciate that. I mean, at the end of the day, these are people that are on hard times, and the pandemic, even if you're somebody who it didn't affect in a negative way, you've got to be empathetic to the fact that it affected a lot of people in a major way. I applied for all the government programs for my tenants. So far, nothing. Yeah, I mean, in general, I know from dealing with state agencies and the agencies that have to dole this stuff out, they are slow as molasses. I mean, think about dealing with the city or the county. I don't know how it is in other states, but in California, it's not fast. It's not easy. But I've got faith that, slow moving, but eventually we'll get paid. And, it's tough for landlords out there. I know ones that from the tenant side, you don't realize. I know somebody who is in a networking group I'm in who bought a 16-unit apartment in Texas, and 28-year-old kid who has worked really hard up to 28 to be able to have enough capital to put a down payment on something of that size, literally like life savings, right? Into this building, which, the numbers look great, and it's going to kick off 3,000 or 4,000 a month in passive income after everything's paid. All of a sudden, COVID hits, and tenants get together and say, none of us are paying rent. We're going to strike, rent strike. You bankrupt the kid that saved for 19 to 29, didn't go out and party, saved every dime, was able to put down $250,000 as a down payment on 16plex because he worked his rear end off to be able to get that down payment. And tenants on their side, like, they just think it's some big corporation that owns every apartment building across the world, right? And so they rent strike and hopefully don't bankrupt this poor kid that worked, the last 9 years of his life to be able to afford that building and try to set himself up for stuff in the future. More so just to keep him in the loop during the meeting. Yeah, for sure. I mean, whether it's a new build or a resale home, you want during the whole process, realtor and lender, title company, and in your case, the new build company, everybody to be in the loop at all times. And I would hope that somebody from the title company, somebody from the build, the realtor, and the lender all have an email chain. And it's like update on Simon Fung at least once a week, right? Here's where we're at. Here's where we're at. Here's where we're at. Sometimes the new build, it might, be less frequent with the updates than the resale stuff that's selling in 21 to 25 days. But still, everybody should be updated on what's going on, because there's an active loan in process. There's construction in process, all kinds of stuff going on. So I would imagine there should be regular updates where everybody's looped in. New purchase, conventional loan, locked in at 2.75 for $2,500 fee. Should I shop around for better rates? 33 more days for closing. I think you're good, Prakash. I'm going to say stick, especially, you're 33 days away from close. This lender you've worked with has put in work. If you came to me and you were in California, I would say you're in good shape. I mean, to shop around to find a 2.75 for $2,100 in fees to save $400, would be a disservice not only to the lender you've been working with and have spent the time, getting you to this point, but a disservice to you. Resubmit all those documents, get everything, for a few $100s, to start it all over, to possibly risk maybe it's a resale or a new bill. I'm not sure which one, but if it's a resale and the seller's like, oh, you switch lenders after you're already in contract, let's see if we can back out of this and get a new buyer. Cause I know buyers are going to pay another 15,000, you risk losing it. Stay put. You're all set. Catherine, thank you. Another super sticker, another chance to tell my kids I'm cool. We all know I'm not cool, but in the eyes of my 12 and my 8-year-old, I'm the coolest dude around. You know what I'm trying to look for right now? I'm trying to look for, let me see. I want to see how many likes we have on this video. Because last week I never thought to ask, and I had somebody in the comments asking about it, but we've got all these people watching live. Quick commercial break to say hit the like button. If you haven't already, hit the like button. We got all these people watching, only 22 likes. You know what I'm saying? I think we can get that up. I think you guys can definitely get those likes up. When evictions restart, no landlord will touch a tenant with a service sector job or anyone with an eviction, especially if a new COVID strain is raging somewhere in the world. You're probably right. It's going to be interesting to see. And for whatever reason, people, I've dealt with tenants of all types, good tenants, bad tenants, in between tenants. And I've tried my darndest to say, listen, I don't want an eviction on your record. I don't want to pay the lawyer fees to evict. I don't want to do any of that. So let's work something out. I mean, I've done as far as you're 2 months behind. And rather than continue to play this charade, be out by next Friday. And we don't have to go through the eviction process. Because then I pay, $1,100, $1,200, $1,500 for the lawyer fees to evict somebody. And so if somebody's got an eviction, it just makes it, it's already hard to rent a house, right? Why make it harder on yourself? And more often than not, it's one of those like choose not to pay versus truly can't pay because, I don't know, maybe different landlords are different, or people who are truly struggling are communicating with the landlord, communicating with the owner, and the owner's like, whatever, and has no heart. But, myself and tons of landlords I know are doing everything they can to help the tenant out and say, listen, pay what you can. Let's work out some sort of payment agreement, especially right now. And so, it'll be interesting to see how that all unfolds. I'm grateful I had the foresight to build a small portfolio of 30 multifamily homes, which keeps me afloat. So far, my tenant arrears are $112,000. Man, Yankee Doodle, I feel for you, brother. I know quite a few landlords who have really been affected. That's a big number. 30 multifamily, if they're, depending on how big each one is, you might have 60, 70, 80 units, and 112,000 is no small sum. So what is it with the most of the counties? Are they gonna do like 80% of back rents or something when you apply for that? I don't even know. I've got a property manager working on it for me, but sorry, man, that sucks. And the bad part for the mom and pop landlord is that, maybe 30% of that is people that are truly, in trouble and they can't pay and they both lost their jobs. But, for the majority of the people who are still continuing to get paid, I've got people that are on Social Security or disability and like literally nothing has changed. They've continued to get paid. They've also gotten stimulus checks and they choose not to pay because, they've got eviction protections. That really sucks. And to be completely honest, there's tons of folks who've got plenty of aid and stimulus and all that. And if it goes to Yeezys and other stuff and not rent, then it's unfortunate, and it's only going to make the future harder for these folks who are going to have an eviction on their record once the, what does it say, comes to roost or something. Thank you for the kind comment. Good information. I'm trying. Wash hands. All right. Thank you, Jessica. Smash the like button for the YouTube algorithm. That is what I'm talking about. Let me see. Oh, see, we got the likes up. We went from 22 to 34. There's still 40 something people watching, and we don't even have 40 something likes. So some people are holding out on me. Total yearly rent roll is 1.5 million. Feel grateful that majority are paying. So 1.5 million rent roll, and you've got 112,000 in arrears. Not terrible. What does that work out to? Something like 8%? Wrong emojis. Maybe you're looking for the like. You like the pertinent game I'm giving out? All right, I'll continue. I'm trying. Anybody who wants me to take this in any direction. That's the cool part about this. Is it's all just a freestyle. Whatever direction you guys want to take it, that's where we're headed. I sued the ones that are ignoring me in civil court, eventually garnish their wages. There's no free lunch. True. I mean, it's unfortunate, and it sucks that even has to be done. Can you refinance an investment mortgage loan? How hard is it? If you got an investment property loan, it's pretty much the same thing as your owner occupied loan, debt to income ratios, and if you qualify, you qualify. Your income plus your net rents versus the debts on all your mortgages, plus student loans, credit cards, car payments, all that stuff. Debt to income ratio, conventional stuff, you probably want to keep it under 45%. If you're there, you're good. What are your thoughts on including lawn care in the rent? Easy write-off, more appreciation. So you are thinking about paying your own lawn care so you can write it off, but then increasing the rent by that much. I think that's what the question is implying. It's a lot easier than depending on a tenant to keep up the lawn care. And depending on where you're at in California, oh my gosh, they will literally drive through neighborhoods and cite landlords for long grass. I mean, the city wants income wherever they can get it. So I think most all of the landlords I know are paying for lawn care and then just adjusting rent accordingly, right? And so I think that's where you're going with this one, and I agree with that. You know, you pay for the lawn care, make sure the home is looking good, and then adjust your rent accordingly. Bad time to buy investment property. Well, I touched on that earlier, and I think that it's certainly not a time where great deals are flying off the shelf, but it's not impossible. And I think that in the investor groups I'm in, the people that are working the hardest to find deals are still finding deals. If you're looking for home runs, you're probably not finding a lot of home runs. If you're looking for singles and doubles, they're still out there. And your criteria can remain the same in this market, in any market, and you just continue to hone your skills on analyzing deals. You hone your skills on the markets you're looking to buy in. And then as you filter 20, 30, 40 different properties per month, only one or two pop out of that filter that are worth offering on. You offer on those. And like I think Yankee Doodle said earlier, he hasn't bought anything in a year. You might not buy anything for a year. It might be that only 2 deals of the 40 you're analyzing every month in the market you're trying to buy in make sense. And you offer on both of those a number that makes sense to you as an investment. I've offered on stuff for 10 months, 0 deals. And so I wouldn't say it's a bad time, but here's what I'll say, because I'm around a lot of investors. You're going to have to get creative. You're going to have to find an off-market deal. You're going to have to find a distressed landlord. You're going to have to find something besides low-hanging fruit, something on the MLS that's 12% cash-on-cash return. Probably not going to be there in 2021, especially with just the amount of demand there is. And yeah, so that's my advice. I am familiar with bank statement loans, Yankee Doodle, and they're making a comeback. In general, stuff that's not Fannie Freddie or considered QM, qualified mortgage loans, bank statement loans, debt service coverage ratio loans, these types of alternative financing for somebody who probably in your case has already reached their max of 10 Fannie Freddie loans and can't do those anymore, or somebody who runs a business, they've got $10,000 a month in deposits, but on their tax return, they only make $17,000 a year. These loans exist, and they're actually, the gap is narrowing. And as interest rates rise on investment property stuff, and we're getting 3.5%, 4%, these loans around 5% aren't looking so bad anymore. And so they're still out there, and there's still plenty of non-QM lenders. Home Express is one that comes to mind where I send some of that stuff. I've got at least a couple in process right now with the team where they might look at 12 months bank statements or 24 months bank statements. And if you've got good credit, enough equity on a refinance or enough down on a purchase, then you can buy with bank statements proving income versus having to show tax returns or something. Similarly, there's products where it's a debt service coverage ratio thing where you're buying a property, you're putting 20% down or 25% down, and the payment is going to be $1,600 a month, and the property rents for $2,000 a month. That debt service coverage ratio, meaning if it's above 1, the rents are more than what the debt service, meaning the payment, principal, interest, tax, and insurance, then you can get loans that way. And those hover around the 5% range too. So not terrible if you can't qualify with conventional financing, FHA financing, which is, you've got verifiable income to cover it. Yep. Now this is a great comment, Jessica, and this is something for Andres or anyone else who's thinking about investment property. The best way to buy investment property is by telling anyone you know or anyone you come in contact with, I'm in the market for investment property. You said you mentioned it to your manager. I mention it all the time to my property manager. I mention it to real estate agents I work with. I mention it to people I know who are actively out there looking at deals. I even went and made a video where I said, this is my criteria. This is what I'm looking for. I've sent it to realtors in the market where I'm looking and said, if you come across something that you think meets this criteria, call me. I'm a buyer. I'm a qualified buyer. Same goes for my property manager. They've brought me everything from commercial buildings to fourplexes to single families and said, what do you think about this? What do you think about this? And I've wrote offers on some of them so they know I'm a serious buyer that's willing to write offers. And so the more people that know you're looking for a property, the better chance you have. And like this, when it's off market and you've got a property manager that brings it to you, you're not competing against all the retail buyers that are going to pump the price up and ultimately make it something where it may or may not pencil for you and your investing criteria. Is it safe to say that conventional loans in California are outdated way of buying? Probably better to get a high risk home with lower rates and somehow a strategy to sell in the near future. You're going to have to elaborate. Short commercial break for coffee. This break is sponsored by Matt the Mortgage Guy. I shouldn't be drinking coffee at 6:45. I'm going to go to the 2-hour mark. I'm going to go to 7 o'clock. Then you guys are cut off until next week at 5. I'm going to put a poll on my channel. So I don't know where everybody is watching from, listening from, or is going to see this afterwards. But I'd love to know, if I did this at 3 o'clock Pacific Standard Time, would I have as much engagement? If I did it at 4 o'clock, what would it be like? Because I mean, for people on the East Coast, it's almost 10 o'clock. It's almost bedtime for you guys. You guys got to pack it up, pack it in. Let me begin. Yeah, see, Yankee Doodle's out in New York. It's got to be past your bedtime. All right, what else we got? We dove into a lot of investment property stuff. I had some questions over here in case. I had some things that I had kind of on deck. I see a lot of 2 and 3 family homes for sale, but the only ones on the market are occupied, so no one wants them. No vacant properties for sale. Yeah, I mean, I think I see a lot of those too. And what I see is, don't disturb the tenants. You're only really allowed to inspect it once you get an accepted offer. So that's really tough as an investor, especially an investor who knows, like we've talked about here, it's hard to evict people if they're not paying rent. And if they're not paying rent, it's not a very good investment. Colorado. Are you guys same time zone as California? Oh, there we go. Boom. See, this is what I had. I had this on deck. Shift. Can I zoom in here? Can you not zoom in on Word documents? There we go. See, this is I've been putting together these sheets as like tutorial stuff for clients, like what's considered assets, because people are always like, can I use gift funds? Can I use money under my mattress? Can I use my 401k or my retirement accounts? This is a cool little sheet we made. You know what I'm going to do? Mountain time. What's mountain time? An hour? An hour from me? I know Massachusetts is 3 hours. Catherine, Illinois, are you guys 2 hours from California, from Pacific Standard Time? I don't get out much, you guys. All I do is mortgage all day, every day. Time zones, not my thing. Mortgage, my thing. All right, this assets thing, we can go into at a later date. How does not paying student loan during COVID forbearance affect credit score? It shouldn't, because those are automatically going into forbearance, 0 interest, 0 payment due, and so there's not anything past due showing on your credit. You should be fine. You want to, when you're going to buy, Catherine, have a payment populate on your credit report. And so if you get into like an income-based repayment plan that says your payment's $65 a month, that's what the lender's going to use. If they don't have a specific payment, then they'll take the 16 grand and 1/2 of 1%, which is only $80 a month, right? So $80 a month is going to hit your debt to income ratio. Probably not going to affect you that much. For people that have $200,000 in student loan debt, bless you. Good luck. Oh, Lane, I appreciate you just trying to throw something out there. Listen, there's no dumb questions. I didn't understand it. Blame it on me. But I asked for questions and you provided a question, so I'm thankful for that. I appreciate the honesty. How about lease options? If you're talking about lease options to buy, those are tough, because I know that the sellers that I've talked to and the investors I know that offer lease options, they require a pretty hefty upfront payment. So they might sell you a $300,000 property, but they want 10% down up front so that they're not at risk, right? So they'll tell you, give me 10% down on this $300,000 property. You've got the option to buy it within 2 years. at the $300,000 price. They usually say you got to buy it at 320 because they're, accounting for appreciation in advance. So you got your $30,000 down, and then you've got a payment, and they give you a rent payment that's a little bit higher than what it should be. But they say, no, you're going to have $200 a month of that rent that goes towards the principal. So you paid $30,000 down payment plus $200 a month is going towards your principal. Well, if 18 months from now you move to another city for another job, or you can't qualify for whatever reason, you can't close in this house, like that 30 grand is just gone. That's just part of the agreement. And so risky. Good question, Flash a Light. Crypto or non-standard statement from Coinbase. Let's see if my team mentioned it on here. They did not. We got to add that. But I know that you can use those funds, but we can't use it when it's still in Coinbase. If you liquidate it from Coinbase and it goes to your credit union account, your banking, wherever you bank, and we show that, Coinbase to there, $37,000, then we can use it for obvious reasons, right? If you own one Bitcoin at 56,000 and we're trying to source that could be 45,000 tomorrow, or it could be 65,000. It's super volatile. So we can source it by showing it coming out of Coinbase, then being in your bank account, but it's not like verifiable assets until it's actually in your bank account. That's for now, for 2021. And you would think that more lenders would see it. I remember back in like 2016, a lender I worked for was already developing guidelines for cryptocurrency. And it was the same then and is now. It hasn't really changed in 5 years. You can use that money. I've had people use that money. They just have to withdraw it and put it in the form of US dollars. I would think if you liquidated it in Coinbase and just had it sitting in Coinbase in dollars, you'd be okay. But while it's sitting in crypto, we're not able to use it as reserve funds or down payment funds. But I mean, that's easy. If you're like, listen, I've got 125,000 in crypto, I'm going to take 40,000 of it, use it for down payment. I'll pre-approve you knowing that you're going to liquidate whatever you need to liquidate for that 40,000 in down payment. When the time comes, you're in contract, you liquidate it. We show proof of that. It came from here. It's now here, and you're good to go. FOB, maybe F, you own it in a fund like GBTC. Man, these guys are talking major crypto talk, man. This is like way past my Bitcoin, Ethereum. Then my knowledge is gone after that. I'm putting 25K into Dogecoin tomorrow. Yankee Doodle, you've got this portfolio of real estate that pays you and it's stable. Why would you invest in Dogecoin? Oh, here's what I told my buddy. My buddy was at my house on Saturday. I'll admit it. We ordered that Thriller Ben Askren fight. I'm ashamed of myself. I'm ashamed of our society for what that thing was. But Dogecoin, okay. Here's my take, Yankee, since we're talking about it. Dogecoin is like the dude made it as a joke, right? And it's got like a $60 billion market cap. This is what I told my buddy. Me knowing very little about crypto, I do know that like there's limited upside, right? Like GameStop could never be a $500 billion company, no matter how much pumping was going on, right? And so similar to that, even though GameStop's like a real friggin' company, Dogecoin, whatever you call it, how much higher can the market cap go, right? I mean, could it double or triple? Yeah, but it's not going to 10x. I mean, there's some real companies, Yankee Doodle, that you can invest in that you like, who the CEO is, how they operate as a business. I could give you some recommendations. Not Dogecoin, bro. I mean, you just seem so sophisticated as a real estate investor. Dogecoin is for Reddit folks and the gambling fools of the interwebs. Not sophisticated investors like us, my man. but I mean, why not, dude? What's it at right now? It's like 25 cents or something. All right, I'm checking out Dogecoin. All the internet people will tell me Dogecoin is the way to pronounce it. Dogecoin. 28 cents. No, 38 cents. Seems high to buy it, dude. I don't know. You're just going to throw 25 grand in there and just let it ride? All right. Yankee Doodle's doing it because he's bored. He's putting 25K in. And he's going to try to hope that it moons. All hail Doge. This is a mortgage channel, guys. I mean, we should be talking mortgage, not Dogecoin. But like I said, wherever you guys want to take this, I'm game. I appreciate everybody tuning in. I think I've got about 3 minutes, and then I'm going to be tapped out. I'm going to have enough fun. Got a couple more calls scheduled for tonight, so I can serve as many people as possible. I appreciate everybody who's watching. If there's any more questions on anything we talked about tonight or anything, feel free to leave them in the comments. My plan is every Monday, 5 p.m. Pacific Standard Time, after I post that poll, which I'm going to try to do that tonight to see when a good time would be. And you guys can let me know too in the comments if 3 p.m. or 4 p.m. Pacific Standard Time is better. And some of the folks, especially guys on the East Coast, would do better earlier. I'd love to do this thing a little bit earlier than I can get out of the office at a decent time, be able to tuck the kiddos into bed. I'm not currently using GSFA Platinum Select. And I'll tell you what, Sherry, if you are in California, I'm guessing you are because Golden State Finance Authority is a California program, you are going to have one heck of a time getting an offer accepted with either that or Cal HFA. I'm more familiar with Cal HFA and their down payment assistance program than I am GSFA. You've got to write a 45-day contract because these things just take longer to close. And it's just the truth. It hurts to hear, and I hate to say it, but you write an offer with down payment assistance. You got to disclose that to the sell side. The sell side knows that you're in a position where there's not a lot of extra money. If the appraisal comes in light, you don't have the money to make up the gap. If there's a couple $1,000s in repairs and they're not willing to do them, you're presenting an offer that has such a small chance of getting accepted that I'm giving people honest advice in 2021 that you're probably better off coming in with your own down payment, even if that means waiting for 6 months or waiting for a year. And really, I'm not telling people to wait because I don't see the housing market slowing down or getting any less expensive. But in the down payment assistance scenario, it's just so tough. And really, when I've ran the math in the past for down payment assistance programs, I've never made a video because I really respect and like the people that work for these programs, and I don't want to badmouth them. But if you're in a position where your transmission breaks and it costs you $2,000 to fix it, the worst place you could go is to a check cashing place and getting one of those cash advances where you pay 127% interest. Down payment assistance isn't that bad, but when you look at some of these programs that offer you a higher interest rate, they offer you added fees, and you've got a second and third loan that you've got to pay back, and those accumulate interest. You're just setting yourself up. The Cal HFA, where you're taking the second and third loan, you owe 105% of that house when you purchase it. So you're upside down from the start. Not a good place to be. Golden State Finance Authority, I think they have a grant where if you stay in the home, you're going to get it forgiven, but you're still going to be paying a premium for that loan. And as great as interest rates were this last year, I had tons of people come to me and try to refinance. Even with the great amount of appreciation we had, with everything baked in with this down payment assistance stuff, they still didn't have enough equity to refinance out of that stuff. They were stuck in those loans. So I'm not a big fan. And that is just my honest opinion. if you want more information on that program, I can connect you with somebody who can give you that. And I think you should. Usually that stuff is posted online. GSFA Platinum Program. Usually they post their rates online. Lender Realtor Resources. Maybe it was Cal HFA I was thinking of. Post their rates. Yeah, I'm not the best guy. This open door program, I know some people that are offering it. Yeah, see, they've got like, all right. Yeah, some realtors are going to do this, and some, Nate and Jess, have been told by their brokerages no on the letters because they open themselves up to discrimination. That's been the latest thing I've heard from realtors that are in the streets, on the ground, is that their broker shops are saying, do not submit a letter with your offer. This was a super popular thing forever and ever and ever. It's opening up to discrimination lawsuits where you're like, hey, why did you give the house to them and not them? Why was it this family, not that family? So they're just doing away with the letters. But I recently got an FHA offer accepted. So it's not impossible. It's just harder. So best of luck to you, Sherry. And shoot me an email, Matt, M-A-T-T, at mattthemortgageguy.com. I'll connect you with somebody who does it all day, every day. I can do it and I can broker it out, but I am of the firm belief that you deserve to work with somebody who does it all day, every day, super familiar with the program. There's people at my brokerage that probably do a couple of those per month and would be happy to help you. I'll gladly refer them. Nothing in return besides telling them I'm only going to send this to you if you take good care of Sherry, because she's a loyal listener, follower. And so, yeah, send me the message. I'll be happy to do the introduction for you. Yeah, it's crazy. It's something that literally like 3 months ago was you have to do it on every deal. And now today, more and more realtors are, and here's the thing. Let me clarify. 70% of realtors are probably still doing it. But the 30% that tell me like, no, my broker told me we're not allowed to do that on deals anymore. And here's why. And it makes sense, right? Like they don't want to open themselves up. They don't even want the possibility of that. And so on this list side, sometimes they're like, do not submit letters. We don't want any chance. I live in California too, where you can get sued over looking at somebody the wrong way. So if there's a chance that you're going to be targeted and sued because you discriminated and gave a house to this family from this background that supplied pictures and their story versus these other families that submitted their picture and their story, it's liability. So they're avoiding it. Yes, Jessica, get on next week's show, please. I appreciate you guys. Thanks for watching. I'm out. Until next week.